Well, once again, this afternoon's session is sponsored by ServNet. Joe Derkos is our man from J.D. Power. Always delivers. Joe, come on up here. Delivers a great presentation. A reminder that after Joe's presentation this afternoon, our opening night networking reception is right next door in the exhibit hall and sponsored by Max Digital. If you would, a warm CPO round of applause for my friend Joe Derkos.
All right, good afternoon, everybody. Thank you, Bill. Thank you, everybody at Auto Remarketing, again, for having me back. This is now the 5th year I think I've done this presentation, and I've always enjoyed it, enjoyed the week, and all the great sessions that take place beyond this. So I'll do my best to give you something impactful, something interesting that I hope you can take back and hopefully benefit your work later this week, next week, or whenever it is that you get back to your day-to-day operations. So the title here is pretty generic, but very much in alignment with what I've done in years past, and we're focusing here on a general overview of both the new and used vehicle markets. We'll start with new, hit some highlights there, transition to used as we make our way to the CPO part of the market, and talking there about how CPO has a huge place to play in the overall industry's strength, how it's helped new prices, used prices, et cetera, and a lot of the sales velocity that we've seen over the last several years, and how it will become imperative next year that we kick it into a whole other level. So before I do that, a really brief introduction of where the data behind this report's coming from. I do this every year. I'll try to keep it briefer than I have in the past, but just so you're aware of what all this information is based off of. All the data you're going to see today is PIN data. So PIN is short for the Power Information Network. This is a division within J.D. Power and Associates that I've been fortunate to work in for 6 years. And the name of our game is we collect transaction-level data from dealer DMS systems. So on a nightly basis, from about 40% of U.S. retail dealers who have graciously allowed us to extract this information, we're pulling their transactional records into our environment. And with that, there comes a whole bunch of interesting information. A few highlights: we can see the VIN of all the transactions that we're pulling information from. So we can translate and decode that VIN and see the make and the model year and the trim and all the content. Anything that's discernible in the VIN itself is all available, which is interesting but not unique. And what makes PIN different is that we can see a whole bunch of data about the nature of the sale itself. So we can tell if it was a cash deal or a finance deal or a lease deal. Within the finance deals, we can see the term mix. We can see the amount financed, the down payment, the rates on the loans, the lender, was it a captive or a non-captive? Within lease, we can see the residual value assumptions and all the factors that go into driving monthly payments, which we can also see. So we can see trade-in information as well. So we can tell, is there a trade? Was there a trade on the vehicle purchased or leased? And we can see the VIN of the trade, so we can decode that and see all sorts of interesting patterns about migration. Are consumers remaining loyal? Are they defecting certain segments? If they are, where are they going? So there's a whole lot of information there available to us in this transactional data set. The nature of this is we enroll a dealer, and when they're enrolled, we get to have access to all of their used and new sales. And I want to emphasize this point. For everything we're going to look at today, we're looking at used sales at franchise retail dealers only. So indications in the industry from some other vendors out there indicate that that's about a quarter to a third of the overall U.S. retail used market when you consider private sale and independents that we're not currently looking at in our sample. So this is just used sales at franchised retail dealers, which in the context of CPO is what you'd want to look at, because that's where you can control and actually certify a vehicle. You can't really certify a vehicle if somebody's selling it via private sale. So in the second point is on the new side, we're looking at retail transactions only. We take a lot of great measures to extract and remove any transactions that are fleet. And we do that because we want to really look at true sales from the dealer to the consumer. So if you look at OEM reported sales, contained in those numbers oftentimes are sales that are pushed from the OEM to the dealer and haven't necessarily been sold to a consumer yet. So we take a lot of care to extract transactions like that. So we're left with a true retail perspective, and that's what we want to focus on. So all the new detail that you're going to see today is focused exclusively on that. So when we have the data, we do all kinds of cool things with it, and this is what makes my job fun. We take the data, we weight it up, make it statistically representative of the U.S. market, and we report out on things like share and incentive spending. And you'll see some of these highlights throughout, and I'll make sure to point those out as we go through it. But we can provide near real-time perspective on share performance. So basically tomorrow, I'll be reporting out on share data through the 15th, which is yesterday. And we'll be reporting out on incentive spend through the 15th later this week. So on the incentive spend number, I want to focus on this just a little bit because it is one of the key trends in the industry that I'll highlight as we get into this presentation, as incentive spend is climbing, as everybody knows. But we quantify incentive spend using our transactional data. We can see the nature of the transactions, and we also know the offers that were out there. So we can see all the communications from the OEMs to the dealers, with the incentive offers. We take that data, translate it into the amount of dollars being spent, covering any type of incentive out there. Bonus cash, consumer cash, dealer volume bonuses, APR support, lease residual support, sales spin, you name it, we track it. And we combine that with our transactional data to create aggregated incentive spend numbers at the model and model year level. So there's an extraordinary amount of precision there. And there's a good amount of math that goes into it. It's all basic arithmetic at the end of the day, but again, that's where the information you're going to see today is coming from. So the final point I want to make is the arrangement we have with our dealers is if a dealer enrolls in our system, they'll allow us to extract the DMS data. In exchange for that, we give them a perspective on their local market and their performance within their local market amongst other PIN dealers on a daily basis. So if you're subscribed as a dealer, you may know what Power Dealer is, but that is a web-based tool that the dealers have access to where they can see their performance again in the context of their local market. And it's a bit unique amongst the other myriad of tools that the dealers have available to them in that this is real sales data. This actually occurred. We're looking at real transaction prices, real turn rates, et cetera. So they allow us to have access to the data. We give them access to that perspective for free. So if there's anybody who's not enrolled and you're interested in this, I'd be happy to talk to you. That's the only sales pitch I'll make today, but it's good information. It helps us to grow our sample and make our data more reliable and more robust. And again, we're sampling 40% of the market right now. Last year at this time, we were at about 32%. So our enrollment's gone up significantly. We've been making a lot of great efforts to increase our coverage. We don't really need to. With 32% coverage, you're at a confidence interval of about 95% plus in terms of representation of the market from a statistical perspective, but we want to get a deeper sample so we can start to do work in more granular forms. As the market becomes more competitive, which you'll see in the presentation to follow, there's a whole new way of managing a business, not new per se, but there'll be more focus on looking at markets in a more tactical fashion as opposed to rolling out national programs. So there's a lot of variety in the US on that basis. So again, retail on the new side, transactions are looking on the U side just at franchise retail dealers only. So that's PIN in a nutshell, and the structure of today's presentation follows two major sections. The first we'll talk about the new market, and then we'll switch to the used and talk about what's happening there and work our way towards CPO and why it makes so much sense, and now more than ever. So let's talk about new car sales. So here's our perspective for retail sales looking back to 2007, and you can see our forecast for this year calls for about 14.2 million units. A couple of things to highlight on this slide. So first and foremost, we're near peak levels, right? So last year to this year, growth was about 5%, and next year we're calling for about 1% growth, just north of 1%. In the last 3 months or so, we've seen some particularly strong sales performance, which might lead us to increase our forecast both for this year and for next year, perhaps by 100,000 units or thereabouts. But if you look at August, September, and October collectively, we see sales growth year over year, doubling what we saw in terms of sales growth through the first 7 months of the year, January through July. So we're in the midst of some really strong recent sales performance, and as we close out the year, again, that number might come up a bit, which is good. It's great news. However, regardless of whether or not we increase that industry forecast, you'll note that next year's growth will be slowing down a bit. So not necessarily a bad thing, but it does bring about a whole new series of challenges, and I'll talk about those as we get into this presentation. And if you dig beneath the surface, it gets a lot noisier as you look within specific segments. So here, as an example, I've chosen a handful of segments that have either grown tremendously or have been struggling basically for the last year or so. And on the top, you see mid-size premium car. These are your 5 Series, your A6s and E-classes, down quite a bit year over year, right? So this is retail sales volume growth from this year to date, January through October versus the same time period a year ago. All adjusted for selling day differences, so there's no funny calendarization here influencing these figures. We've seen genuine retail sales volume declines within some segments that are particularly strong. Mid-size premium cars is a big one. Mid-size car, they're down 7%. These are your Camrys and Accords and Malibus and Fusions and Altimas, down in volume year over year. On the opposite end, you see some tremendous growth from some of the segments, specifically in the SUV space. Small and compact SUVs have been positively on fire for the last year. It even extends back into 2013, where you see small SUVs growing tremendously, compact premium SUVs. You've got entries like the Lexus NX that's done tremendous things both for the brand and for the segment. Compact SUVs is another strong story. So the good news here is that for brands that are well diversified from a portfolio perspective, they can handle this, right? You lose a mid-car buyer and you just pick them up with your compact SUV. But not all brands have been structured that way. There are some out there that are losing volume in the mid-size and compact car space and don't have a legitimate or a competitive entry in the parts of the market that have been growing tremendously well to really absorb that loss. So It's important to realize this in the context of the industry, our perspective on industry growth. Again, it's slowing, but beneath the surface, things get a whole lot more volatile and require a bit more strategic management going forward. So before I come back to the challenges that slowing growth poses for the industry, I wanted to talk about another point of strength, and that's transaction prices. So here we're trending transaction price over the last, well, since 2007 again, right? And you see in 2015, we're expecting another record. We basically set new records ever since we were back in 2008. And this transaction price measure is net of incentive spend. So I want that to stick with everybody because we're going to talk about incentive spend specifically in a couple of slides. And you'll see that that number has climbed quite a bit. But this number nets that out. So we take the negotiated vehicle price between consumer and dealer, and we extract away the quantified incentive spend that I mentioned as I was introducing PIN earlier. And that's a net figure. So despite the fact that we've seen incentive spend climb, and I'll show you that in a few slides again, transaction prices have grown. And that is a function of two things primarily. We have seen a shift segment-wise towards segments that are higher priced. So trucks and SUVs have been doing quite well. GM with its Utes, Ford and GM with their trucks. There's been a richer mix of industry sales from trucks and SUVs. In fact, truck mix and SUV mix combined have exceeded historical norms, making, therefore, by definition, car mix as low as and as weak as it's ever been. But part of that strength you see for the industry is a shift towards more expensive segments. But more than that, and the bigger chunk of that increase from last year to this year is by virtue of all models, basically, and generally speaking, increasing their pricing. So everywhere you look, you've seen price gains, be it in a segment that's been weak or in a segment that's performing particularly strong. Again, it's a generalization, but it's true if you quantify the effects of that $600 increase. About 3/4 of it comes from genuine price gains, and the remainder comes from segment shifts. So that's growth of just over 2% year over year. That will be a challenge going forward, and I'll talk about a number of reasons why. But I want to hit one final point here on new industry health. And here we take the retail sales volumes that we see across the industry and cross it with the transaction prices I just showed you to derive what we call consumer expenditures. So it's basically a gauge of how much money consumers are spending on new vehicle purchases. And you can see here $435 billion this year, up $28 billion versus a year ago, up almost 7% year over year. So fantastic growth. And this for us is the quintessential definition of industry health. The press seems to publicize more about volume. They fixate on volume and total volume at that, not really retail volume, which I think is the most important part of the industry. But also, we want to introduce the pricing strength that we've seen. It's rare that you get both at the same time. I guess in the broader historical context, we've been fortunate in the last 5 or 6 years to grow out of the recession and grow out of bankruptcies and have been able to grow volume and price concurrently. That may not always be the case. So we should all enjoy this because things are pretty good. So some of the challenges, as industry growth slows and we see a whole bunch of new products come to market, we're creating a very ripe market for intense competition. So this figure here is showing you the number of products that will hit market in redesigned form or all new introductions. So basically, this year we expected 98 new or modified or brand new entries or majorly redesigned products to hit the market. So all the product development investments of 3 or 4 years ago are now really coming to bear in a big way. And next year we expect that trend to generally stay the same. So about another 100 vehicles will be redesigned or refreshed for next year. And with that level of redesign comes a whole lot of pressure from each OEM. So there are business cases behind each of these redesigns. They expect to achieve certain volumes to justify the product development investment. And that creates, again, an environment where if you stacked up everybody's objective, you'd have a number for the industry that's far, far off the charts, way in excess of what we're going to forecast. So you've got smaller incremental pieces of real estate being added to the industry each year, but a whole lot of product development investment that needs to be recouped and a whole lot of business plans that need to be realized. And the industry has a tendency to go after these objectives as aggressively as they need to. And one way they do that, before I do that, just some facts and figures. In 2013, if you look at all the models that are in the industry, we take each model and look to see did it increase its sales year over year or not. We saw 3/4 of entries in the market managed to do that in 2013. This year, only half managed to do that. So here's the facts. They don't lie, right? So it is becoming a more competitive environment. That slowing industry growth is becoming a bit more of a challenge for brands to realize their respective objectives. And what folks do when their objectives are at risk is they start to manipulate price. So here we are finally at the incentive spending slide. So here are your incentive spending figures for the industry. And again, this is coming from our incentive spending analysis. I told you a little bit about how we do this. Again, we're trying to capture everything that's a consumer-facing incentive here, from the OEM or a captive lender to the dealer. And we're quantifying that at about $3,200 this year. So that's up about $200 versus last year. And that's up above the last historical peak we saw way back in 2008. So potentially concerning, right? So this is one key industry health indicator that we keep a very close eye on. And we're not sounding any alarm bells yet. And the reason for that is you've got to really take it in consideration in the context of the general pricing environment we see in the market concurrently. And here we're looking at incentive spend as a percentage of MSRP. And you can see we're at about 9.2% this year. So it's still shy of what we saw back in 08 and 09, which is maybe a good comparison, maybe not, but we're still shy of what we've seen in recent history. So for that reason, we're a little bit more comfortable with that rising incentive spend number. But more than anything, what makes us most comfortable is that transaction prices have managed to continue growing. That's the slide I showed you when we saw a $30,600 average transaction price for the industry, which again is net of this incentive spending number. But certainly something to keep an eye on. And as we go forward, the competition that will be created via smaller pieces of new real estate being added to the industry and all the product investment that's coming to bear will be a challenge. And interest rates, which we'll talk about in a little bit, which will only serve to inflate this incentive spend number. But if you look at the amount of dollars that are being spent by OEMs and or captive lenders here, we're calling it at about $45, $46 billion this year on incentive spend. So combine this with the consumer expenditures and you really get a true picture of the amount of investment out there from both consumers and the OEMs to realize the strong sales performance that we've seen as an industry. So it's happening. Some of it's naturally as we recover out of the recession, but a lot of it is stimulated with pricing effects. So this is one of the key things we're going to keep an eye on going forward, that incentive spend number. And in the context of used, what we're going to talk about in a little bit, incentives today flow right through to the used market nearly immediately. They impact residual values, they impact the ability to continue to command strong used prices, and we'll break that down as we get into that section of the presentation. So what are they doing with the incentive budgets? Well, one thing they're doing is more and more long-term loans. Now, rates have been low, money's been cheap, but there are still a lot of active participants in subventing loans out to 72 months and sometimes even 84 months most recently. And if you look at this trend, it's a continuation of what I've shown, I think, for each of the last 3 years. It's in terms of percentage of industry retail sales, we see 34% of sales this year being derived from consumers with a 72-month or longer loan. That's percentage of sales, not percentage of loans. So basically 1 out of 3 new vehicle buyers are using a 72-month or longer loan. So this is concerning for a number of reasons, and there's a direct tie into the used market here, but the concern is that the longer you extend that purchase cycle, the longer it takes for folks to get into a positive equity position, which might thereby keep them off and on the sidelines instead of coming back to market to buy a new vehicle. And what's really helped to prop this up and keep this dynamic sort of artificially inflated is the fact that used prices have been so strong. And I'll show you the figures on that later in the presentation, but with strong used prices, positive equity is reached sooner, so regardless of how long that loan term is, folks can come back and buy a new vehicle. But that may start to catch up with us as we start to see used prices soften a bit. But what's also helping us to offset this effect is a simultaneous peak in leasing. Again, very much built up on the foundation that we have within the strong used vehicle market. So residuals are a function of used prices, and lease monthly payments are a function of a strong residual. And we could see that directly relating here to the strong lease spend that we've seen year to date. 28%, it's a new record high. But if you look at this in broader context as to what this means for the flow of consumers back to market, if you take the average term length of a loan, it's crept up about a month every single year, thereabouts. We're up to 67 months on average. But for leases, it's been dead steady at 36 months, at least for the last 3 or 4 years. And if you combine these two at the prevailing mix that's going on in the industry for loan and lease, 34% for long-term loans, the finance mix is richer, the 28% lease. If you combine them together and look at the average term of consumers in market, you can see it's been dead steady at 57 months. So this means that you'll have a steady flow of consumers coming back. Maybe the long-term loan folks sit on the sidelines a little bit longer, but there's more and more leasing happening. And that will keep those folks coming out of leases and back to market in a steady flow. So this dynamic's imbalanced. It's perfectly balanced right now, I should say. But going forward, some of this might be called into question in the ability to continue to subvent out to these longer-term loans. And one driver of that will be rates, right? So this is top of mind for everybody. You can't read anything in the economic or financial world without getting some perspective or some thoughts on when the Fed's going to make a move to increase the Fed funds rate. So here you're looking at a really broad term of history all the way back to 2000 and what that rate's been. And you can see it's been dead steady, just shy of 0% for the last, 6, 7 years, basically, back to 2009. And I've got 2 points of view here, and they're intentionally divergent. One's from Standard & Poor's Rating Services, the sister company of ours under McGraw-Hill Financial, and another's from Oxford Economics, a partner of ours that we work very closely with through LMC forecasting. And the agreement between these two is that we should expect to see rates increase in December. That's when we think the Fed will make their first move. It will be really predicated by strong unemployment figures rolling in this month, validation of the strong figures that we saw in October, but also, a check on inflation, which has been pretty non-existent over the last several years. And if those things come in as they hope them to, consensus is that the Fed will make a move in December, perhaps a third of a point of an increase versus where we're at today. But where we go from there really is, and you can see it here, a wild guess. You've got S&P thinking that we'll get to 3%, north of 3%, by late 2017, where Oxford's a little bit more conservative, calling for about 1.5 points. But you can't argue, and I said this last year, it's a matter of if and when, but that if and when is pretty imminent. It's going to be here very, very soon, perhaps as early as next month. So that will have an impact on the auto environment, specifically in the ability to continue to do long-term loans. And it'll be really interesting to watch, and especially as this impacts non-captives, because you think for non-captives, money's been so cheap, they've been able to participate actively and aggressively in the auto lending space, and they've taken a big chunk of business from the captives. But as rates go up, the captives have a lot more influence on their ability to subvent out to long terms, and it makes it more difficult for non-captives to compete for that business. So this one will be definitely very interesting to watch, and that will only serve to increase that incentive spending number, and it won't necessarily be in a consumer benefiting way, right? So that will be something to keep a very, very close eye on. So back to 2 slides ago, we talked about long-term loans, we talked about leasing, and what leasing will do as it's grown and recovered from the pits of the recession, where we saw that materialize in a low point in lease maturities of about 1.3 million units in 2012, will drive a huge increase in lease maturities next year. So if you follow these guys on Twitter, Mary Lou and the auto remarketing gang, you probably haven't been able to avoid this quote. They extensively pushed this one, that we're calling for an 800,000 unit increase in lease maturities next year versus this year, which is a lot of extra volume coming back to the market. Really quick, our math on this is really straightforward. We can see lease volumes based on our estimated industry retail sales, the lease mix thereof, and we can see the term mix within leasing, so we can very easily project how many leases will come back to market. This is theoretical in nature. It doesn't account for vehicles being totaled or destroyed or bought by customers or for pull-ahead activity. This assumes that every lease comes back at exactly its maturity date. But you can't argue with that increase, 800,000 more units next year. So this will serve to increase used supply, creates a huge opportunity for the new side. All these lease returns are new car buyers, and it creates a ton of supply for CPO, and that's where we're going to kind of turn the corner and talk about that in the slides ahead. So a few other things that we didn't mention on the slides, but we should keep an eye on. Fleet, didn't talk about this very much, because generally speaking, it's been very responsibly used. Running at about 18%, that's what it was in October. A little bit more volatile in the last 6 to 9 months, but generally within the normal historical range. I wanted to mention this though, because this one can change quickly. This is one of the outlets that brands have as their objectives seem to be out of reach. They can pull the incentive lever, but they can also pull the fleet lever, and we haven't seen a whole lot of that occur to date. It's been very responsibly used, but it can change quickly. Fuel prices, that car weakness that I showed you in the first slide, in many ways a direct function of fuel prices and where they've been. They've been very, very low. No indication that will change anytime soon. So we do expect to see continued pressure on cars and strength within SUVs and trucks, which could be a good or a bad thing depending on whether or not you occupy both parts of the market. In VW and diesels, you can't talk about the auto industry these days without discussing this, and it's a big deal for them. The diesel market basically has gone away overnight. VW owns about 80% of that space when you look at non-trucks and non-SUVs. It's a very small piece of the market. Remember, VW's 2% share, and a significant chunk of their portfolio is from their TDIs, which are currently in stop sale. And now this is bleeding through into Audi and Porsche, and there's speculation that this could affect all diesels out there. But it remains to be seen how pervasive this will become and how VW will really handle getting out from underneath this. But they're already underway in that attack. But certainly a challenge for them. So the conclusion here on the new market is things are really good, right? Go all the way back to that first slide, and the second slide, and the third slide. Strong retail volumes, strong transaction prices, more money being spent than ever. We've pulled some levers to get there, but we don't think we've pulled them to the point where they're going to break off or the industry is going to spiral out of control. Just some things to keep an eye on, like incentive spend, long-term loans. There's other things like subprime. We've got Gen Y, Gen X buyers coming to market and increasing rates. So there are new challenges, but generally speaking, the new market's in a really good place. So let's switch gears and talk about the used market. Used sales in the franchise retail space here again, and here's our forecast for this year, which is nearly an actual number at this point, and for next year. So you'll note we're calling for a million unit increase basically for used sales in the franchise retail sector of the industry. That's a 9% increase. And a lot of this is, again, predicated by that rich lease mix or lease return volume increase of 800,000 units and more purchase maturities coming back as well. as some incremental volume flowing through wholesale lanes as they make their way to retail. But a big jump in used volume is what we're calling for next year. But from a pricing perspective, we have a very strong story here as well, just like we do on the new side. So industry average used vehicle prices in the franchise retail space, again, are just north of $20,000. That's where we project they'll finish the year, $20,200. And you have the same figure for new transaction prices here, same figures you saw back in the beginning of the presentation. And I want to put them side by side so we can do a compare and contrast. So looking at used prices relative to new, we see that relationship at the highest level it's ever been. Now, admittedly, the y-axis on this chart scaled dramatically, but you can't argue with the fact that this is at peak level. And this is important because used prices on their own in absolute form are interesting, but when you look at this from an industry perspective, at least we want to look at it as to how do used prices compare to new, for a variety of reasons. If you consider a would-be used buyer going into a showroom, they may be enticed to buy a new vehicle, especially when you can get a 0% rate at 72 months and there's some bonus cash on the hood. That new vehicle price is more in reach than it's ever been when you intended to buy used. And conversely, if you're looking to buy a new vehicle, it's probably less likely that you're going to go over and buy a used when they're priced as high as they've been relative to new. This, however, this trend we do expect to perhaps slow down a little bit and reach its peak and start to retreat as we go forward. And for that reason, I'll share some information from some colleagues of mine at NADA Used Car Guide. I think you guys probably know, but J.D. Power acquired NADA Used Car Guide back in the summer. So I'm extremely excited to have my colleagues, I can call them Larry Dixon and Jonathan Banks, are here at the conference as well. Both of them will be on panels and or speaking tomorrow and Thursday, so be sure to go and see what they've got to share. But here I'm pulling data from their portfolio, and this is their NADA Used Car Guide Used Price Index. And what you'll note here is that in the last 4 or 5 years, we've been near peak levels. So very, very strong used price when these guys control for mix and mileage and age to really try to create a comparable population of used vehicles over the years that you see. But what we're going to see in the years ahead is the beginnings of some softening. In fact, we've already seen it a bit this year, used prices softening, at least in index form, by about 1% to 1.5%. And going forward, the projection at this point is a 2.5% to 3.5% decline in 2016 versus this year. And that's all a function of the used supply increase that we're going to see primarily. So certainly we'll see that used to new relationship follow a similar trend as we go forward. So to revisit the topic of lease maturities, same data we saw earlier, but it's going to become very critically important that folks manage their lease portfolio more aggressively going forward and more strategically. And just as a few anecdotal examples here, we have some examples of folks who are doing that. BMW does pull-ahead programs frequently. They've got a program in place right now and have for quite some time for 3 Series that mature in the beginning of next year, trying to pull them back to market. BMW is one of the brands that will see a big increase in lease maturities next year. So rather than let them all flow through at the same time or at the end of their maturity date and create a big remarketing challenge, they're looking to take advantage of a short-term new sales opportunity, tap into some of that equity that's available within their lease portfolio, and bring these guys back to market while also minimizing that remarketing challenge. And you've got others doing it as well, Dodge, Buick, GMC, just as a few anecdotal examples again. But again, going forward into that big increase in 2016, it's going to become important to continue to do this type of thing exactly. And with that lease maturity growth comes a lot of CPO opportunity. So here's a first look at our forecast for CPO in 2016. Now you'll note our forecast for this year is 2.5 million units. We set that last year at this time and have held it all the way till today. So we just eclipsed the 2 million unit mark in October. I'm thinking that 2.5 might be more like 2.6 when it's all said and done, depending on the severity of pull-aheads that occur in the last 2 months of the year. So that could creep up a bit, but next year, from this year to next year, we expect basically about half of those lease maturities, that 800,000 unit increase, to turn into CPO units. And I'll give you some reasons why as we get into this in a little bit more granular form. So there you have our projection for next year. 2.9 million units could come in closer to 3 when it's all said and done. And it's all predicated on the assumption that we're going to see a continuation of this trend, which is really important. And we're going to talk a lot about this in the next couple of slides. But what you're looking at here is the percentage of used sales within the franchise retail space that are actually certified. And you see some nice, strong linear growth over the last 4 or 5 years, getting up to about 23% this year. Our expectation is that will continue to climb next year to 24%. That's a big assumption because with the increase in supply, it doesn't necessarily mean that we're going to certify 24% of that population. So it won't come naturally. It will require a lot of work, but there's been a lot of investment. There's been a fair amount of runway to get ready for this increase. I mean, when all the brands originated these leases, it should come as no surprise that you're going to see a bunch of lease maturities 3 years later. And they've been investing in CPO programs to do that. We've been observing and studying many of them, and that's what we how we quantify these measures, and that's based on our observations of CPO and estimated used vehicle sales for the industry. So we are expecting that mix is going to continue to rise. And why is that? Well, here we're looking at brand level performance. I don't normally show brand level stuff, but here it is. You can see each brand's respective number. So that 24% industry number is built up based off of these brands. And again, just to define that, we're looking at CPO sales volume in the numerator, and in the denominator here, for each of these brands, we're looking at their respective brands' used sales anywhere in the used franchised world. So to pick on Mercedes, for example, you could see about 40%. This is 2012 Q3. 40% of Mercedes sold in the used franchise space were going through their CPO program. That's pretty fantastic. That's about 1 out of 2 almost of all of their used car sales are being certified. And if you animate this in, you'll see about 26 of the 31 brands that we're studying have managed to increase this performance over the last 3 years. And the brands that haven't are generally explainable. And the Japanese have been facing a supply drought created by the tsunamis years ago. They're just about to put that in their rearview mirror. And some other brands have changed their incentive structure and or had difficulties working with their captives to secure that off-lease supply. So you understand where brands have taken a step back, but more often than not, in almost all cases, 26 or 31 brands here have increased that performance. And we expect that to continue into 2016. And same number here for 26 of 31 brands are expected to increase their lease maturity volumes. So here again, you're looking at the industry lease maturity schedule that we showed you previously, this year versus last year, and where those big increases are coming from. And you guys will get a copy of this presentation. I believe Mary Lou will post it online, but pretty substantial gains there. You've got Toyota way over here on the left. Oops, I got to go back. Big jump this year to next. But again, almost everybody's increasing. And if you look for the ones that are retracting, they're small in size. We've just got a binary yes-no here of are they increasing or are they decreasing. But again, if you sum that all up, it's an 800,000 unit increase, and you can now see how it's distributed across the industry. So one way I wanted to look at this might be a fairly complex chart, so I'll try to set it up so it's easy to understand. But I want to take both of those most recent measures, lease maturity growth and CPO penetration, and put them in one place. So on the x-axis down here on the bottom, you're going to see the increase in lease maturities by brand next year versus this year. And I'm going to animate in a whole bunch of data points. Each point will correspond to a brand. So the further right you are, the more increase in lease maturity volume you should expect. And the further north you are on this y-axis, the more likely you are to certify a rich proportion of that lease maturity growth. And if you animate these in, the blue bubbles here correspond to non-premium brands, and the red correspond to premiums. And the size of the bubble denotes their CPO volume. So a couple things jump out immediately. You've got a very large non-premium brand here who more likely than the rest of the non-premium set will certify a rich mix of the vehicles coming back. And you've got some others here who don't certify perhaps as rich of a mix, but are still expecting some sizable increases in lease maturities, and they're big volume players in the CPO world. And even with the premiums, you can see up here on top, those that are most likely to certify are those that are the biggest and have the biggest increase in lease maturities next year. So it's just another way of looking at the data that I had put on the previous two charts. And again, all this feeds into that forecast for next year. We do expect that the lease maturity volume growth will be a boon for the industry, but it is all predicated again on brands responding and actually going out and certifying at historical rates and in fact growing that penetration. And we believe that that will continue. And here's the last slide as we kind of wind this up. I'm going to demonstrate a bunch of the virtues of CPO. We did something like this last year, but we're going a little bit deeper this time. But the first thing that's important for CPO is that it creates price strength, right? So if you have a very engaged dealer body, it's likely that they're going to consume their used vehicle capacity on their lots with their brand's vehicles. And that's an important thing because within the data that we can see, when you keep a vehicle, a brand X vehicle sold at a brand X store, it commands a much higher price than it would if it were to sell at a competitive store. So here are some facts on that. Pretty dramatic number here. We're looking at 2015 year-to-date average used transaction prices for vehicles sold at a same brand store versus those sold at a different brand store. And to try and get past any mix effects that might be influencing this, I've limited this to vehicles that are less than 3 years old and less than 36,000 miles. So there's a 19% price premium there. It's pretty substantial. So it's in the interest of the OEM and of the dealer and anybody involved in this space to keep same brand vehicles at same brand stores. We don't want to segregate, but there's some virtues to doing this. And CPO helps this. As you get dealers engaged in CPO, it's more likely that they're going to go after their own brand's vehicles and look to carve out some of the performance benefits that CPO offers. So what are those? That's what I want to kind of finish this presentation with. And this is the type of data that we use extensively with our clients to help them communicate the story of CPO and the benefits that it offers. So what you're going to see here in this big gray box is data extracted from a proprietary analysis we do for one of our brands in the industry. I can't say who it is, but they're a large brand that has done tremendously in terms of promoting their CPO program over the last several years. The data is from Q3 of 15, and we're looking at a 2014 model year volume model within their portfolio, all right? So that's all of these metrics and what they correspond to. And just to set this up, we're going to look at a number of performance metrics from a dealer's perspective. So the very first here is CPO price versus non-CPO price. And a little bit more background. You can see here, in this case, the CPO vehicle is selling at about 6% higher of a vehicle price than the non-CPO. That non-CPO population, the transactions that comprise that, we limit to those that could have been certified. And by that I mean we look at the transaction, we can see the model year, we can see the mileage, and we can see if it was sold at a same brand store. Anything that doesn't meet any three of those conditions is excluded from the study. So what we're really looking at here are CPO sales relative to non-CPO that weren't certified but could have been. Right? So you remove the arguments that dealers might pose as to the noise in the system for vehicles that they didn't have any ability to certify because of their ineligibility for the program. So 6% price premium, and again, that would stack on top of the price premium enjoyed by just keeping the vehicle in network. And this is what the OEMs are interested in, residual value strength. So all that strong performance in the new market I talked about with leasing and long-term loans are all predicated on this strength in the used vehicle space. So it gets really good for dealers. This vehicle in particular is turning 27 days faster when it's certified versus when it's not. And this is what the beauty of this report is. This is, in fact, this is an analyst's dream. When we put this stuff together, you know the story's there. And when you quantify it and it comes out this perfectly in this size of magnitude of the advantage that these guys are realizing, it's really cool. But you can see a 27-day turn rate advantage. And this is one of the primary arguments that dealers will give about, well, if I take the vehicle, I'm just going to slow my velocity, especially if they're on a heavily velocity-based model. I've got to recondition it, re-inspect it, it's tying up my service lanes, I'm going to slow my pace down. Well, not so fast. That's actual data, I'll remind you, coming from PIN. This is real transactional information coming from dealers. And that's a massive advantage. That should get any dealer's attention, a 27-day turn rate premium. In addition, they're making more gross profit. So here's the same perspective, CPO gross profit, 5.8% of their cost versus 3.7% when they don't certify. And just to be clear on this metric, the cost base here on the denominator is an all-in accounting cost from a dealer's point of view. It entails the acquisition cost of the vehicle, transportation costs, floor planning, the CPO fee, any reconditioning, brakes, tires, anything they put into this vehicle up to the point of sale are accounted for. So this overcomes another argument from dealers in that, well, the vehicle's already really expensive to acquire because used prices have been so strong. Now you want me to go and put new brakes and tires on it and drive the price up. I'm not sure I can recover that investment and make my gross. Well, they can, and they can make an incremental gross above and beyond what they would have otherwise done as demonstrated by this. So 2.1 percentage point advantage in ROI basically from a dealer's perspective. So faster turn rates, higher gross, it's hard to argue with that performance. In addition, for not only the dealer but for the OEM, these customers are exceptionally more loyal than non-CPO buyers. So here we're looking at all the non-CPO trades that all the CPO trades we can see in our system. So when we see a trade in, we can trace the VIN back, determine was it sold as a CPO unit when it set out on its life, and then look at where those customers go to. And this brand specifically, this model, are almost twice as likely to remain loyal to the brand when it's a certified vehicle versus when it's not. And that means, here 58% of these vehicle disposers are buying a new or a CPO or a used vehicle from the same brand that they just got rid of. That's, again, almost twice as likely as the ones that don't certify. So tremendous benefits here, and we're really just scratching the surface. There's all kinds of other benefits, F&I income opportunities, service contract opportunities, captive opportunities, the list goes on. And this is the sort of thing we quantify in this analysis. We do this work for about 50% of CPO brands, at least brands corresponding to 50% of CPO sales in the industry currently. A lot of you guys are here, so you know what I'm talking about. But if you're interested in this type of work, I'd be happy to talk to you offline. And for anybody, even if you're not, if you can take this slide, print it out, and bring it out, this is not adjusted, not manipulated. It's based on the real transactional data that we can see. Just some very simple arithmetic applied to it, and we're just reporting the facts. So pretty compelling information. And we wanted to close with this because as we see more off-lease volume, as we see mounting pressure in the new market, it's important for all of us here who are pushing CPO as an industry to continue to do that. And that will serve a primary function in the longevity of the new market and in the used pricing strength that we've seen to date. And this is where it happens. When you engage dealers, and not only getting them engaged, but also getting them to tell the story from a consumer's point of view and all the benefits that they realize along the way, which I haven't even touched on. But it's all about getting them on board, getting them hooked on the juice like you see here. This stuff is real, it's not made up. And once they enjoy those benefits, it's hard to get them to go away from it. So to summarize, new market, exceptionally strong, very strong retail growth. Volumes are near peak levels. We're going to see some slowing growth going forward, however. And some of these enablers of growth might be going into yellow territory if we're going to keep a yellow, green, red assessment of everything, like long-term loans, and rates are going to have an impact on everything. But generally speaking, things are very, very strong. And the CPO market still remains the hottest place to be. It's growing faster than any other portion of the market and has a really critical role to play going forward, especially, again, with these lease maturities coming back and the ability to make sure that they command the highest price possible, and that's what CPO serves as its primary function. So the challenge, again, getting dealers engaged, keeping them engaged when they're already on board, and getting them to certify as many of those vehicles as they possibly can. So I'll leave it at that. I'll be around happy hour afterwards, but all week, and happy to ask questions or talk about this stuff offline as you guys see fit. But thanks again for your time. It's a privilege to be here. Bill, thank you a million.
Joe, thank you.
Great.
Incredible data there. Joe Derkos with J.D. Power.